From Deloitte Tax, welcome to Tax News and Views podcast. In this series, we talk to specialists from Deloitte about the latest business issues and developments. I'm Carrie Falkenhayn, your host for Tax News and Views. Today's discussion is part of our global series focused on Pillar 2. Some of our listeners may be familiar with our U.S. series, also focused on Pillar 2, but more specifically focused on the issues U.S. multinationals are facing. This series is focused much more broadly. Today's topic is on the safe harbor guidance that global multinational companies need to understand and consider. Today, I'm joined by two leaders in Deloitte's Pillar 2 efforts, Daniel Stutzman, who is a Swiss partner, and Jim Petrie from the U.S. So thank you both for joining me today. And maybe we can talk about some of the new guidance that's coming out and how the temporary safe harbors changed how companies prioritize as they look at Pillar 2.
Yeah, thanks, Carrie, for the introduction. It's a very interesting question you have raised, and it had clearly an impact of the approach our clients are taking in relation to Pillar 2. So essentially, the temporary safe harbors have been approved in December 2022, and they have been designed as a short-term measure that would effectively exclude the multinationals' operations in certain lower risk jurisdictions from the scope of GLOBE in the initial years. Thereby, the safe harbor would allow a multinational to avoid undertaking the detailed GLOBE calculations in respect of that jurisdiction if it can demonstrate, based on its qualifying CBCR and financial accounting data, that in that jurisdiction it has revenue and income below the de minimis threshold, or an ETR that equals or exceeds an agreed rate of 15% for 2024, 16% 2025, 17% 2026, or no excess profits after excluding the routine profits. The transitional CBCR safe harbor uses revenue and profit, loss before income tax from a CBCR report, and income tax expenses from the financial accounting data after eliminating taxes which are not covered taxes and uncertain tax positions. So here we already see the first deviation between the normal CBCR and qualified CBCR. And then essentially you use this data to determine whether the multinational's operations in a jurisdiction meet these tests. And if you do not meet one of these tests, then essentially you're required to do the full calculation. I have to say that you cannot use the CBCR for the routine profit test, but you would have to do the full substance-based income exclusion calculation. But on the other hand side, that is not too complicated. On that basis, multinationals groups in scope have started analyzing the CBCR to assess the jurisdictions that are at risk of failing one of these three tests. So we essentially see them categorizing them in low risk jurisdictions, high and middle, where potentially you have to look at whether there have certain measures to be taken in order to mitigate the exposure of falling out of the safe harbor. The risk of falling out of the safe harbor is essentially that once you're out, you are out. That means you have to do the detailed calculations, even if in the next year you would again meet the safe harbor test for that jurisdiction. So what we see with our clients is they have used their CBCR filings for previous years, typically 21 and 22, to assess the jurisdictions at risk. And quite surprisingly, there were jurisdictions in scope that would have failed that test that you would not have expected. So we saw a lot of clients that had Spain highlighted as at risk, occasionally also Germany and other known higher tax jurisdictions. Why was that? On the one hand side, we saw that there were a lot of government-driven COVID relief measures that still did drive rate and financial data for 21 and also still 22. Also, the recognition of deferred tax assets can be a big driver in essentially driving the ETR for that jurisdiction. And also, we should not forget about incentives and grants that potentially could benefit some of these groups in these jurisdictions. And what clients are then essentially doing is identifying a trend, because obviously you cannot rely on the 21-22 data for 24, but you can identify a trend and also use the opportunities. So, for example, in 23, to ensure that you can recognize any deferred tax assets that you may have not yet recognized before. And here I'm referring to IFRS standards, where it's saying more likely or more probable that you can use it. Obviously, for GAAP, it's slightly different. It would have to be treated from a valuation allowance perspective. But so we saw a lot of clients first taking here first steps on analyzing potential measures to be taken. But then on the other hand side, we also saw that this has impacted their approach in relation to reporting and compliance outlook, because a lot of clients are essentially now relying on the temporary safe harbors for managing their reporting and compliance obligations. So we saw a shift in saying, well, wait a moment, I'm not yet going ahead with a full-blown technology solution implementation project, but I have identified a small hand of jurisdictions. Switzerland is typically one of them that is in scope of the calculations. And I apply a more pragmatic approach in essentially saying, I use my existing reporting tool, I update that to reflect the Pillar 2 requirements for 24, and then essentially manage my reporting obligation through that, and essentially gain some time and assess the market in the development of technology solutions that will help them drive their compliance going forward. So I think that is quite an important aspect, because it shifted the timeline quite a lot in relation to implementation project. So momentarily what we see, it's way more advisory related projects, and also helping them with regard to the validation of their country by country reporting.
Yeah, Daniel. And in what we see in the US, there's a couple of different nuances that are perhaps more focused around US GAAP. But one of them is for folks that are thinking about transactions close to this calendar year, perhaps looking at doing them ahead of year end. So things like moving assets between jurisdictions that may create a tax step up, or perhaps transactions that may release a valuation allowance against the deferred tax asset. And part of the reason for that is because, from a US GAAP perspective, that can create an effective tax rate benefit, right? And given these safe harbors, these temporary safe harbors, and the effective rate one is in a lot of ways just a metric of US GAAP effective tax rate as compared to 15%. And so things like valuation allowances releasing or step up in basis transactions can create an effective rate benefit. And so to do that ahead of the first year of safe harbor becomes very important. The other thing that we're seeing from a US point of view, and perhaps you are as well, is it's brought to the show, if you will, the country by country reporting. This has been obviously a rule in many countries, including the US, to report out that information. That in the US gets reported to the IRS. But I think in a lot of cases, companies can spend that much time validating and confirming the amount put in the country by country report. And because of the safe harbor, and because it likely will be used as support for financial statement auditors, companies have spent more time validating that report during their compliance season this year to get ready for 1/1 of 2024.
Talk to us a little bit more about what that validation process looks like when an organization's looking at their country by country reporting to see if it will be qualified.
So it's interesting. Again, the OECD has introduced a new term, qualified CBCR. So essentially, qualified CBCR means that the country by country reporting needs to be prepared by a acceptable accounting standard as defined by the OECD in the model rules, respectively by an authorized accounting standard that is considered reliable. And we had a lot of discussions, normally clients can either apply a top-down country-by-country reporting, usually using the consolidated accounts, usually using US GAAP, IFRS, or from a Swiss perspective, Swiss GAAP, FAR, or you can apply it using a bottom-up approach using local accounts. For Switzerland, and I also know that for many other European jurisdictions, that question of using a local accounting standard became quite interesting because, yes, in Switzerland, for example, you file your returns on the statutory accounts. However, our accounting standard for statutory purposes follows the principle of prudence, therefore not a true and fair view principle, and consequently is not considered reliable. The same applies to other European jurisdictions where quite often you don't record for deferred taxes. And obviously, as deferred taxes are a big driver of your ETR, they need to be considered. So our recommendation is to taxpayers, clients, on the one hand side, have a consistent approach. So best rely on the consolidation standard that you use for consolidation purposes at the level of the ultimate parent entity, but only in other cases where data may not be available on a jurisdictional level, then potentially look at the local accounting standard. On the other hand side, we also realized that there could be the opportunity to have a acceptable authorized accounting standard that is usually not used for tax purposes because the treatment for CBCR reporting may be different. So that could apply for an opportunity in managing your safe harbor. On the other hand side, here it has to be noted that the OECD is issuing guidance on the usage of accounting standards and consistency in their application for purposes of the safe harbor.
Yeah, Daniel, and that's become a big discussion point because companies are, perhaps historically they might have, like in the US, might have used US GAAP figures throughout their country by country reporting. And the question they're asking themselves is whether there should be any deviation. If, because US GAAP eliminates the impact of a lot of intercompany transactions, statutory financial statements in some instance might be a better reflection of what's happening economically in a jurisdiction. And so companies are looking at that, right, and analyzing whether or not they should change in particular jurisdictions to move away from a US GAAP standard. So that's one thing that we're observing, and you hit it on the head. The OECD is also having to contend when you use different standards across the same group of entities. It can create a situation where you can have inconsistent treatment associated with the same transaction, right? Just the counterparties with the transaction. And so that's created some pressure points that we're likely to see more guidance from the OECD. In terms of validating the country by country report, I think this has brought to light a couple of things that perhaps aren't all that relevant or haven't been all that relevant within the books of our clients, of our US based clients. And part of the sea change here is that the recording of book income in the profit before tax or financial accounting net income or loss is defined by the globe rules. It becomes very important where income and expense is booked within the consolidation. And so it brings to light things that are booked perhaps topside within an organization that ultimately should get pushed down or will get pushed down. And so companies are spending time looking at those items that are booking topside historically and whether those should be pushed and where they should be pushed within their organization to properly reflect the financial income, in a jurisdiction. And so these things were always relevant from a deferred accounting perspective, but perhaps weren't all that relevant because most, countries outside of the US used a statutory metric to calculate their taxable income. The other thing that has now become the norm, but is something that, wasn't all that relevant before is effectively the treatment of intercompany transactions. And what I mean by that is the US GAAP treatment or IFRS treatment, instruments like preferred shares between legal entities. And what it is brought to light is that, thinking about the accounting treatment of those instruments, whether they're considered debt or equity for US GAAP purposes, and whether there's any embedded derivative in those contracts, become very important because your baseline for country by country reporting for safe harbor, as well as for the Pillar 2 rules, are rooted in the financial accounting net income or loss, which is based on either US GAAP or local accounting standards.
Thank you for that. And so we've been talking a lot about the temporary safe harbors, but we now have recent guidance from the OECD talking about permanent safe harbors, particularly around QDMTTs. So what are some initial thoughts on how this changes the reporting and compliance considerations our clients are going through?
So in July, the OECD came out with their guidance on permanent safe harbors, essentially saying if a country has implemented qualifying QDMTT, that essentially then an IIR jurisdiction would not be allowed to levy in a top-up tax following the income inclusion rule. The interesting point about that is, on the one hand side, to be considered as a qualified QDMTT, the qualified QDMTT needs to be implemented in line with the model rules, and respective processes by the tax authorities need to be considered and adhere to ensure a compliance with the model rules. On the other hand side, what the rules here introduced was that jurisdictions could also use a local accounting standard for the application of the QDMTT. And again, here then the question comes up that it either needs to be an authorized or an acceptable and reliable accounting standard. Just this morning, I had a conversation with a client asking about that and saying, well, should we potentially switch then for the QDMTT safe harbor to essentially prepare data on Swiss GAAP FAR instead of IFRS, and whether that would provide a bit more flexibility? In the end, it outlined that the local accounting standard here in Switzerland with Swiss GAAP FAR was quite similar to IFRS and would not have provided for many differences. One difference could, for example, be the treatment of trademarks, whether they can be amortized or would have to be impaired, which is an interesting aspect to be looked at. On the other hand side, if you then apply that approach for a Swiss headquartered multinational or someone that would apply that approach in general in Switzerland, it would mean, look, on the one hand side, you would have to do the statutory accounts for the current tax calculation. Then you would have the Swiss GAAP FAR accounts to determine your QDMTT and potential top-up tax, and then still have the accounting standard used for normal tax reporting on the US GAAP or IFRS. So it would essentially mean introducing a third standard and consequently add a lot of complexity just from an accounting and reporting perspective. Why did the OECD introduce that? I think one of the main aspects there was to make the life of the tax inspector easier because they think they have a better understanding of essentially their local accounting standard compared to, for example, US GAAP.
Yeah, that's right. And that's been the push and pull here. And maybe just so the way that I frame this, because I think the lens in the outside of the US versus inside the US, UPs or ultimate parent entities in the US, I think slightly different lens. Because I think that the US folks, before this permanent safe harbor came out, were thinking, okay, this is ultimately the end state computation is going to be this is for the detailed Pillar 2. So we're no longer in this temporary safe harbor world. We're past that. And the concept is that, okay, I'm going to be able to use my US GAAP figures to do my computations for Pillar 2. So in other words, I'll be able to use the same data set. And before this July guidance, before these permanent safe harbors, the way the mechanic worked is you had effectively duplicative computations. So the local country would do a QDMTT for this local tax on their local income using the Pillar 2 rules. And then you'd also do a computation using the globe rules, using US GAAP, and you paid the higher of the two, is the way that mechanic worked. And that created complication, right? Because you potentially have to do two separate computations. So this permanent safe harbor, what it does is it eliminates that additional computation. So now, and Daniel's talking about like, okay, how's this going to roll out in each jurisdiction? But what they're eliminating is instead of doing the local QDMDT computation plus the US GAAP computation, you just do the local computation. So that's helpful, right? Because you have one less computation to do. But the difficulty is, and this is to Daniel's last point, like how are authorities going to audit the computations if it's all based on US GAAP in all these other jurisdictions? Because they don't, presumably in a lot of jurisdictions, don't understand, US GAAP accounting principles. They know local statutory. And so the OECD came out with this permanent safe harbor, which allows countries to continue to use that local statutory IFRS, perhaps US GAAP, but they choose in those jurisdictions what companies will use to do their local QDMDT computations. It's important because, right, you think about that from a process perspective within an organization, oftentimes statutory financial statement data is not something that's done necessarily for your US GAAP close. It might be done much later. Well, now that data perhaps is going to be relevant. Now we're going to see in implementations here, this rule came out in mid-July. And so countries are starting to informally say which direction they're going and which accounting standard to use, but we will likely see it over the next 3 to 4 months. And so the pressure point will be for organizations is, how to gather that data. Is it relevant for financial accounting reporting? And how are we going to do the compliance long term? And that's caused the same dynamic that I think we've been seeing, which is just this computation. It's a lot of data. It's a lot of computational exercise. And there's perhaps still a need for centralization, within organizations to process all this data to make sure there's consistent treatment amongst jurisdictions. But it's definitely a sea change. And I think it's important for us to all sit and see how this pans out in each jurisdiction, but also be prepared, as organizations to react to it. Now, the helpful thing and where we started this conversation was the temporary safe harbors, perhaps are still going to delay the need to do all that detailed computation to, post 2026. But that becomes even more important, right? That organizations meet that temporary safe harbor.
Well, you both raised the issue of tax authorities and how they're going to look at these computations. To share a little bit more, what do we think the permanent safe harbors are going to do to how the taxing authorities view the calculations?
Yeah, Carrie, as you know, there's a high level of uncertainty still around the interpretation of certain of the rules. And certainly also the interpretation can deviate from a country perspective. The benefit of a permanent safe harbor relying on the QDMDT and thereby on an assessment by the local tax authorities essentially means that when you have received an assessment by the local tax authorities, that you should be certain that no other jurisdiction would be in a position to tax you. And I think that is, from a reporting and just from a certainty perspective, extremely helpful and important because you have certainty that no additional top-up tax would be due and that your position should be accepted. And consequently, also the expectation is that this would simplify overall the assessment process. Because imagine that you would otherwise have to wait for feedback from all the authorities that could potentially look at your calculation. Also, on the other hand side, it provides the benefit that in jurisdictions where taxpayers are closer potentially to the tax authorities, that you can get upfront confirmation on the interpretation of certain rules before you enter into reorganizations. So it simply really adds certainty.
Yeah. The way I see it is that permanent safe harbor, and you hit it on the head, Daniel, is it's somewhat consistent with how we've gotten certainty in the past because it becomes a local tax, right? The QDMDT is on, if it's in Switzerland, it's on Swiss income. As opposed to these globe rules like the income inclusion rule, which it would be the tax collected by the parent entity for the Swiss income. And so it's a little bit more difficult to get certainty in those instances. I think the US, because the US is not on board with Pillar 2, for US-based multinationals, there still is a layer of uncertainty because the US is on the US income, right? The US is not going to does not have a QDMDT, so they're not going to meet a permanent safe harbor, at least in their current state. And that means that the under tax profits rule applies or can apply to the US income, which means that in those instances, you'd still have a lot of jurisdictions, basically all the jurisdictions that implement Pillar 2 would all potentially have a say in the computation of, the effective tax rate, the amount at the top of associated with the US earnings. And so it was for that reason that, as part of the July guidance, presumably that's the reason that the OECD provided an additional 1-year delay associated with the application of this under tax profits rule. In other words, the tax on the US earnings for US multinational, provided an additional 1-year delay. So there's already 1 year delayed in the application of UTPR, of the under tax profits rule, for just the normal rules. So instead of it being 2024, it's 2025. This would delay it to then 26. And so perhaps the acknowledgement was that the administration of that, from an authority perspective, from a certainty perspective, perhaps the OECD acknowledged the fact that that's going to be a big pressure point for organizations, especially for US-based multinationals, because you're not going to have that certainty like you would associated with the QDMDT.
Well, thank you, Jim and Daniel, for sharing that background on the safe harbors. Clearly, a number of benefits to organizations if they can qualify under the safe harbors, but also a lot of complexity and new considerations. So thank you for sharing that with us. As I mentioned at the beginning, this is part of a series focused globally on Pillar 2 issues. We also have an episode focused specifically on compliance and technology, as well as a separate episode focused on the accounting issues associated with these rules. So hope our audience is able to tune into those. If you'd like more information from Jim or Daniel directly, you can reach out to them on LinkedIn. And we have a lot more information on Pillar 2, as well as a variety of global tax topics on the Tax at Hand app that you can get at any of your popular app stores. Thank you all for listening. I hope you continue to be well, and I hope you listen to our future episodes. Take care.